I want to talk to you today about a number that doesn't show up in your retirement account statement. It doesn't show up in your net worth statement either, but it's real, it's significant, and for most high earners that I work with, it's one of the biggest risks sitting in their retirement plan. That number is your deferred tax liability. And today we're going to talk about what it is, how it works, and what you can do about it. Hi, I'm Tom Meyer. I'm an independent financial advisor, and I work with many people just like you all across the country, often virtually. And I work with executives and high earners who are at that 3 to 10 years from retirement. Tax planning is one of the most powerful levers we have in the pre-retirement window. And today, I want to show you exactly why. Let's start with the first principle. When you contribute to a traditional 401k or a traditional IRA, you're making a deal with the government. I'll skip the tax today, and I'll pay it when I take the money out. That deal felt great when you're in your peak earning years and you wanted every deduction you can get. It feels less great when you realize that every dollar you withdraw in your retirement, every single dollar, is taxable at ordinary income. Now, think about a high earner who has spent 30 years maxing out their 401k, getting the employer matches. That account might have grown to 2 million, maybe 3 million or more. The government has deferred claim on a substantial part of that balance, 22%, 24%, maybe more, depending on your retirement income picture. So you don't own that full balance. You own the after-tax portion. The rest is a pending tax bill. This isn't a catastrophe. It's a planning problem. But it only becomes a solvable problem if you identify it, address it with enough time to do something about it. Here's where the tax problem becomes a tax crisis for many high earners. Required minimum distributions. Under the current tax law, once you reach age 73, you're required to take minimum distributions from your traditional retirement accounts every year, whether you need the money or not. The IRS calculates that amount based upon your account balance and your life expectancy. For high earners who have accumulated 2 million or 3 million in a pre-tax account, the RMD at 73 can easily be 80,000 or 100,000 or more annually. That's 80,000 to 100,000 of taxable income being dropped into your tax return every year, on top of Social Security, on top of any other income you may have. You're being pushed into higher tax brackets by a rule that gives you no choice and no flexibility. And it compounds. As you draw it down, the balance grows in the other accounts, and even next year's RMD is recalculated. So if the market performs well, your RMD can actually increase as you've taken the money out. It becomes very difficult to manage your tax bracket once you're in RMD territory. The window to do something proactive is before RMDs begin. Ideally, it's your late 50s, maybe early 60s. Now let's layer the problem on what I call the invisible retirement tax, IRMAA. That stands for Income-Related Monthly Adjustment Amount. It's a Medicare premium surcharge that applies to high-income retirees. Most people have never heard of it until they get the bill. Here's how it works. Medicare looks at your income for 2 years prior to determine your Part B and Part D premiums. In 2025, if your income exceeded $106,000 as an individual or $212,000 as a married couple, your Medicare premiums start to increase. They increase in tiers. At the top tier, you could be paying well over $500 per person per month for Medicare Part B alone, compared to the standard base rate of about $185 a month. Now, think about what happens with your RMD kicks in at 73, and you push your modified adjusted gross income above those thresholds. You're not just paying higher taxes, you're also triggering higher Medicare premiums. On top of each other, it's a compounding problem that was largely preventable with earlier tax planning. The good news? For clients I work with in their late 50s and 60s, this is the time to restructure. Roth conversions, strategic account rebalancing, income timing strategies can be meaningfully reducing your future RMD exposure and your IRMAA risk. But the window, it's finite. So what can you actually do about this? There are several strategies. The right combination depends on your specific situation. But let me give you the framework. The most powerful tool most high earners have available to them is the Roth conversion. Converting pre-tax 401ks and IRA dollars into Roth dollars. Paying taxes now on your current bracket in order to eliminate future RMD exposure and allow the money to grow tax-free. There's no RMDs on Roth money. We're going to dedicate a full video to Roth conversions in the future, because that deserves some full treatment. There's also qualified charitable distributions, or QCDs, a strategy for retirees over 70 and a half who give to a charity. So instead of taking RMD and donating it from after-tax proceeds, you can donate directly from your IRA, which satisfies your RMD without the income hitting your return. A high charitably inclined high earner? This is genuinely useful. And there is simply a discipline of managing your income during the years between retirement and RMD age, using lower income years strategically to fill up tax brackets and conversions and withdrawals rather than waiting for RMD to force the issue. Each one of these strategies requires a runway. The earlier you start, the more you do, and the more you can do, the lower your lifetime tax bill, often by a significant six-figure amount. The tax time bomb in your retirement account, oh, it's real, but it's not a crisis. It's a planning challenge. It's one of the most rewarding ones to solve because the math is clear and the strategies work. If you want to understand your specific exposure and build a strategy to reduce it, visit www.schedulewithtom.net and book a phone call or a Zoom meeting, and let's set up that discovery time. We'll look at your accounts, map out your projected RMD path, and talk through what makes sense for your situation. Or until then, I'll see you in the next video. Take care.